let's start with the Nasdaq, man. Like, what a power ramp here into the end of the week. Like, starting the week pretty much out at the lows, right? Of the month, and now we are pretty much nearing the monthly highs.
Yeah, the Nasdaq doesn't want to give away Momo. Doesn't want to flip to bearish trend. And I think we are in that environment that we were talking about a few podcasts ago where both equities and bonds can move together as long as the outcome and the expectation remains as a slowdown and not a recession. I think that's kind of the ballpark that we're in right now. And that's kind of what we're seeing in Fed funds futures as well, pricing in the floor at around 3% in the Fed funds rate. So the market's really just expecting a slowdown still, but we
Right.
are seeing bonds break out. And RQF did make new all time highs this week once again. So it's been a pretty good week. We did see a bit of a sell off today on Thursday, but I mean, futures are open right now and it's already pretty much reversed. So I think we are still looking pretty good for Friday on bonds.
Yeah, I mean, look, speaking of bonds, right? Sick entry here when we flipped on in early July. And I don't think there was a single day where we were actually underwater, right? We had some drawdowns, obviously, but like from when we entered, we've just seen higher. And I do expect like as the bond trade progresses, there will obviously be dips. Some may be buying opportunities, others may be the signal that it's time to exit the trade, right? With that, we'll have to make the decision, or at least for that, we'll have to make the decision with the system stats when we get them as it occurs. Right now, I mean, bonds are looking real good. Dips seem to be getting bought. TLT specifically can't really accept below mid vamp. I mean, we tried here in early August or late August, excuse me, early September. It failed and rallied right back up to upper vamp. So, as those who follow us know, this is our mantra, sorry, is if we are above mid vamp in a bullish trend, new all-time highs or new highs, in this case, bonds are not making all-time highs, right? So new highs are the base case. If we are below mid vamp in a bullish trend, consolidation is the base case. So as long as we hold the mid vamp line on bonds, new highs are going to be the base case expectation for us, given the current regime. If the regime changes, of course, then our outlook has to change. Now, for those that are just listening on the podcast, remember we have a regime model that updates daily and is provided to our members in what we call the quant deck. It's available on our website at market-radar.com. Radar members get access to it. You guys can go sign up and get immediate access and see all the updated stats as we update them on a daily basis. And you can follow along with our portfolio if you'd like at your own will. But let's go.
I want to address a question that we actually get pretty often. We got it back when we were long the Nasdaq as well, and we have been getting it recently now that we're long bonds is what is our price target? What are we aiming for? At what point do we sell out? And I just want to address that. We don't have price targets. We don't set price targets and think of just an arbitrary number for us to get out because we're not that smart. At the end of the day, the system is the powerhouse that's dictating everything that we do. We don't know how high bonds are going to go. It's very possible that growth turns around, inflation remains steady, and we do get a rebound in stocks. We do get a sell off in bonds, but it's also possible that we do go towards a recession, which that's what the system is currently telling us. It's telling us that the odds of a recession are higher than the odds of a growth rebound at the moment, which is bullish for bonds. And we don't know how high bonds are going to go in that scenario. So it's all up to the system. It's fully systematic. We don't use emotions or anything like that. It's all systematic. And we do not
Right,
have price targets. So I just want to address
right.
that.
So to exactly what you said there, we're basically riding the bond trade until the system says otherwise. So for those that are confused as to what's going on, we kind of are too. We're just here riding the wave. No, but in all seriousness, we're gonna take this day by day as we have been since the beginning of our podcast. We've said this since day one. Um, we manage risk as it comes, and the system is forward looking enough to manage the cycle, and we just kind of go with the flow. A lot of people were giving a lot of hate for long bonds down here when we did it, for things saying like, inflation is just on the verge of reaccelerating. Um, the deficits are way too big. No one wants, basically, who is going to buy the bonds? A lot of nonsense, right? And here we are, uh, quite considerably higher now, and those chants have kind of dampened. And now people are actually debating about if they should be buying bonds. And I think that's where we are right now. We're not at the point where people are like, man, I missed the bond move. I don't think this type of move, especially when you scroll out in bonds, this is not a move where people are like, I missed the bond. I think that kind of reaction only comes when you have a recession. And like you just said, right? We're in a slowdown, and a slowdown doesn't necessarily mean we are going to be guaranteed a recession thereafter. It's just a slowdown, right? And slowdowns sometimes don't slow further and they rebound, and you have a return to a risk on environment. But the system pivoted to risk off, and that's where it's pretty much staying right now for what it seems. And until the system flips, we're going to go with the flow.
Yeah. Do you remember the kind of hate that we got when we were long equities?
Oh, that
Basically,
was
in the
ridiculous.
whole shitstorm, we're like, all right, we're longing equities now because the system told us to. And I don't know if you remember that guy. He was actually a member in our Discord and was sending us paragraphs on why he doesn't think it's a good idea to long equities when we first
Yeah.
longed.
Yeah.
And
Listen, I'll tell you this much.
needless to say, that guy actually unsubscribed and equities proceeded to rally harder than they have in a very long time. It's funny how that
Yeah,
works.
I know. And ultimately, right, like the RQF's up 50% for the year. Now, this is not going to happen we may not finish up 50% for the year. Like when it comes to, I think a lot of our listeners know by now, we're pretty much neutral emotion wise. Like just because we're up is not like, we're the king of the world, like 50% year, we're the best out there, right? Like it's a good return, but, it's just the numbers, right? Like this is what the system is providing, and we're happy to take it. And we could have an underperforming year or a flat year too. Like this is the part of the investing, right? So we're obviously happy to take a 50% year, but a lot along the way to get to the 50% mark, we're just under it right now. We've had a lot of battles, especially with our viewpoints at first. Our viewpoint was long equities and the Fed should be cutting rates back in Q1, Q2 of this year. And I remember tweeting that and saying if the Fed doesn't cut rates this year, it's a policy mistake. And that was just an absolute hated tweet. I mean, the comments were basically calling us retards. Like, it was just crazy. And like, I understand at the time you had this little blip in inflation, and everyone was like, oh my God, like inflation is going to reaccelerate. Sure enough, it didn't, right? We just got CPI earlier this week, and it's below 3% now. So inflation has not reaccelerated materially. And equities obviously went higher in the process. Now bonds are also higher, right? Since our move to bonds after we left equities. All in all, you can always find a bearish and bullish case, but that's not how money is made, right? You have to focus on the culmination of all the data and how it's all computed in the end. And you kind of just have to put your money where the highest probability of success is. And that's, I think, what the system does for us in a very clean and precise way, which gives us the ability to kind of just take a deep breath, take our steps forward every day, and kind of just walk the walk. And eventually, we hope that our models have back tested pretty ridiculous CAGRs in the 30 to 40% range, and so far we've proven it, and we hope to continue to prove it. Granted, again, there's going to be great years and moderate years and sometimes poor years, but the idea is over time we think we can really just show our weight in gold, and that's the objective of Market Radar, and that has been the objective since day one. But I think we could bring it back to the fact that the current regime, as we've been saying for the past couple of months now, is certainly risk off, and things like Bitcoin continue to signal similar characteristics of what risk off would look like. But we spoke about this. I think it was last pod or the one before that. You're not seeing that recessionary action in Bitcoin just yet, right? It's not dumping. It's just range bound. And again, this is another sign that look, slowdown is likely right now. Recession is not the base case. And I think like you're not going to come to a point where you're going to say recession is the base case and you're going to win. So like by the time recession is the base case, the trade's already pretty much baked in and over. So you kind of have to go with the flow. Like we're riding the slowdown wave in anticipation that the slowdown does continue and doesn't rebound. But our system is somewhat sharp enough that if it does pick up a change, we will react accordingly, right? Otherwise, we're going to stay positioned for the slowdown to progress into likely a recession. In that case, Bitcoin, if that recession were to materialize, would be down significantly. I don't think Bitcoin's going to trade range bound in a recession, right? So this is just one of your like easy, quick BTC USD onto your chart, and you can just see, yeah, no recession here right now. And I mean, just look at unemployment claims, right? They're pretty much topping out too. The continuing jobless claims, they're not really breaking out either. Certainly, maybe there's some stability forming in the labor market, but again, this can change very rapidly. Labor likes to break down real quick and accelerate pretty much when everyone thinks it's all okay. So our system is not going to make an irrational decision based on one continuing jobless claims print. But I think we should move on to the Fed, right? You brought up a great point earlier about what's going on with the Fed funds futures or the projections of where the Fed's going to be in the rate cutting cycle and just the outlook on how that is being represented in the bond market.
Yeah, like Fed funds futures also in the same park as everything else, slowdown territory. That's what they're telling us. Slowdown territory. So this chart actually, great chart that you made here showing the maximum and minimum of the forecasted Fed funds rate. So we're seeing the minimum not even below the 2018 peak yet. Like, what is that telling us?
Well, see, that's where we go back to. I've had a couple of X posts or Twitter posts about this at this point. You have all these economic data points coming in sub 2018, right? Like sub peak, like this stage of 2018, these levels were sub at or below those levels, right? Real growth, inflation, and you look at inflation swaps, right? All these things are implied inflation expectations. They're all below. Growth and inflation are below these levels, right? So you look at where the Fed is projected to go, and they're projected to bottom out above 2.5%. The Fed funds rate, the effective Fed funds rate, did not breach 2.5% in 2018. So we are going to bottom out above where the Fed peaked out in 2018 and started their cutting cycle. So I have a few questions, like what has changed significantly, right, since 2018? And these are questions that they're more rhetorical because no one can really give me an answer. Like what has changed since 2018 that really means the Fed has to have a much higher neutral rate?
Well,
Some people will say
we had
inflation.
historically high inflation. I think that's the argument that a lot of people have because we had this historically high inflation. We have the argument of the base rate is now going to be 3% instead of 2%. And there's those
Right.
kind of
And
arguments. That's really all I'm seeing. And well, first of all, that's against the Fed's mandate. So
yeah,
I don't see
that's my
why
big
that would
point.
be the target. But second of all, like, would the Fed funds futures really be thinking that? Or is that just dumb money thinking that?
No. So I think there's some understanding here that the Fed is going to bring inflation back down to 2%, which is why I think I also think the market thinks it's going to take quite a long time for the Fed to get inflation sustainably down to 2%, which is why the Fed funds futures are doing what they're doing. But at the same time, I think like the way inflation's progressed, right? Like think about the anomaly, all the anomalies of this entire like inflation cycle. Inflation went way up and then came way back down, and it did so without experiencing a real recession, right? We had whatever that was, like a mimicked recession in 22, but it wasn't real, right? Um, like real spending, or I should say consumption never actually contracted with GDP. It was more of like an illusion effect based on the contributing factors within GDP than the actual growth itself as a whole going down, right? It was just a couple outliers that basically pulled it under for 1 or 2 quarters, and then back up we went, right? So what we didn't really experience a real recession in 2022, but the stock market went ahead and priced that in real quick. We didn't get it. And I think like there's this belief that, you know, because of all these anomalies, the Fed is in a situation where these signs of weaker unemployment, maybe weaker inflation, obviously softer inflation, softer unemployment, softer growth, right? Real growth, I should say, are all alluding to the fact that, you know, maybe the Fed is in a situation where they can't cut right away because it's another anomaly where it's only weak right now, but it's weak. It's call it a weakish, call it a soft bullish patch where like we're going to reaccelerate out of it higher. I think that's what's holding up the curve here, right? Because there's this idea that like at the end of the day, real growth at +2% is not is not recessionary, right? It's a slowdown from what we've been seeing, but it's not recessionary. So I think that's what kind of is like holding up, call it like the like Zeus holding up the world right here. Like that's what's going on. And I think that's pretty much what's preventing the bond market or yields from really breaking down. But ultimately what I'm looking at, right, is I think that the Fed is considerably restrictive for what we're seeing in the economy. Now, some people will say, oh, it's just seasonality, but whatever. Say whatever you want. The Fed's at 5.25. Inflation is near 2.5%, right? Inflation swaps are below the 2018 levels. Inflation is below the 2018 highs, right? So like at what point is the Fed going to be too far behind the curve in a situation where them not doing something like 50 basis points next week, like for example, if they were to cut 50 basis points next week, it wouldn't be traumatic. It's been televised already. We had Fed speakers bring this up in conversation saying they might have to pull some rate cuts forward, right? If we got 50 basis points of cuts at the next FOMC meeting, I don't think it would be a tragic thing. The market shouldn't get spooked. The market's already been somewhat prepped on it, which is why you see the odds floating around 25% chance right now that we do get one 50 basis point cut. But I think like you kind of have to do that because in my opinion, the cutting cycle should have started already. We should have started this cutting cycle like early. We were talking about this literally Christmas, New Year's of 2024 of how like the cutting cycle there should have been some agreement or some first step forward in the process. And that's why we were tweeting in early Q1, Q2 of this year that not cutting rates is a huge policy mistake. And obviously that wasn't consensus at the time, but now everyone's like, you know, not only are we talking about cutting rates, now people are unsure if we're going to get 25 or 50 basis points. So sentiment has completely moved. And the problem here, in my opinion, is like, if the Fed doesn't cut 50 basis points, and they don't start making these adjustment cuts, if you have the fundamental belief that the Fed is in fact behind the curve, they're only going to become more and more behind the curve. And at some point, they are going to be left looking for a corner in a circle room, and they're going to panic. Right? That's what's going to happen. So I think ultimately here, the Fed needs to kind of close the gap here in terms of, you know, call it real rates, whatever you want to, whatever it should be, without panicking. And they're trying to allude to that. We'll see what they do next week. But the ideal move is cut 50 basis points, see what happens with inflation over the next couple prints. Maybe start a 25 basis point meeting by meeting cutting cycle until you're down to 4% if inflation's under 3%. You could pause there for a while. There's so many ways. Obviously, we're not economists. We don't work at the Fed. You know, we're not the PhDs, as they say. But the idea is that the Fed's pretty far from where the market is or where the economy is positioned. The economy is more positioned to where it was in 2018 than where it should be for the Fed to be at 5%. That's our basic thesis there.
Yeah. My anecdotal theory, like just there's no science behind it. It's just what I'm feeling in my balls. What I
I love these feelings.
these feelings are very accurate. What I see happening right now is 2022, we had the Fed hiking at rates unseen in a very long time. Nobody knew what was happening. Nobody knew how high the Fed could hike rates. So right away, the market started pricing in a recession, was thinking, okay, there's no way this economy can handle these rates. Like, we've been at zero for such a long time. Now all of a sudden we're hiking rates, and every meeting it just keeps going higher and higher. Fed funds futures kept pricing it higher and higher, and was just getting surprised constantly, and was expecting a recession right away. Now the Fed is at 5%, and now we're kind of getting the opposite of, okay, nothing happened, so nothing's going to happen. I think that's kind of where we're at. So let me break it down in a simple way, because I feel like that didn't make any sense. The market thought the recession was going to come right away when they were hiking. It didn't think about the policy lags. And now that policy has lagged so far and nothing has happened, the market is still thinking, okay, everything's okay. It's fine. While those policy lags are still in place. And I think those policy
Right.
lags are eventually going to start hitting. And I mean, we are starting to see it hitting already. We're seeing real estate gridlocked for a very long time. We're seeing real estate prices coming down now. We're seeing people losing their jobs. There's tons of companies doing layoffs, doing budget cuts. It's slowly starting to ramp up, while the market is kind of thinking nothing's really going to happen. I think we'll be good at 3%. And that's why it's pricing in the floor at 3%. That's what I'm feeling in my balls.
Right.
That's what I think is happening right now.
I think that's a good simple way, or a way to simplify it, right? A good way to like just lay it out there. And ultimately, like, do I think the Fed should do 50 basis points? Yeah. Do I think they're gonna do 50 basis points? I don't know. Probably not. Right. And luckily for us, what matters because we're long bonds, obviously. So now you might say, well, if you're not going to get the 50 basis points, you're screwed, right? You own bonds, you're going to get wrecked. Not so fast. Bonds care about this blue line right here. This blue line, the minimum of the next, this is plotted over a rolling forward 30-month period, a 36-month period. So over the next pretty much 3 years, they expect the Fed funds rate to hit a minimum of just above 2.5%. It's close to maybe 2.75 is where we're at right now. Ultimately, if we get 25, not 50, this shouldn't change significantly. What needs to happen here is we're going to see the dot plots come out. That's what I'm more focused on this next FOMC meeting next week, right? I'm not focused on if it's 25 or 50. It's irrelevant. I'm focused on where the Fed is updating their unemployment targets, their PCE targets, right? Because they focus on PCE, not headline, not CPI. So their PCE targets, their unemployment targets, and obviously their long-term inflation forecasts, right? Not so much the short-term PCE, but the long-term. And then with that at the bottom, you're going to see the long-term Fed funds forecast and where they expect, rates to pretty much bottom out at. That's the idea. You can kind of see the bottom out and what the Fed's thinking rates are going to go down to. I think if the Fed brings that down somewhat, that will help the bond trade. And that will be the real, the move on the dots are going to be more influential to bonds, in my opinion, than the 25 or 50 basis points. Like, that's really where we're at this point. And I think, if you look at the chart here and just break it down simply, the Fed's expected to bottom out above 2.5%, right? Okay, that means this is not recessionary pricing. If there's a recession and growth is slowing and inflation is slowing, inflation's already in the twos, the Fed is going to have most likely bring the Fed funds rate at or below the inflation rate. So, and that's going to happen quickly, not in 3 years, right? So the idea here is that this is a little rich in terms of inflation expectations, but it's rich in terms of recession expectations, but it makes sense for a slowdown. This is what a slowdown I would think look like in terms of where the Fed would go. Now, some quick just look backs here, right? When SVB happened, the Fed was expected to come down to 2.5% with that banking crisis, right? That was a flash pricing, right? They were expected to cut rates down to in the cutting cycle, was expected to actually commence much quicker, come down to 2.5%. That reversed as SVB was was stabilized with the BTFP. But ultimately, right, if the Fed was expected to come down to 2.5% because of a crisis, inflation was much higher then than it was. Like if we take, let's take a look at where inflation was, right? Like what's going on, right? So when SVB hit, we were up here on inflation, right? We inflation was at 5%. Inflation's at 2.5% right now. Yet we still can't take out the SVB lows. So what I'm trying to say is this is obviously there's no crisis is priced into bonds at the moment. And I'm not saying we need a crisis to make money. We've made a decent amount of money so far without a crisis. But the objective, like for the people that are saying like, oh, the market's a recession is coming. The market's not anticipating a recession. So there's alpha there in case it does come. That's the most important thing.
I'm
And
curious.
if
I'm sorry to cut you off. I'm curious
go ahead.
what the unemployment rate forecast is going to be for 2025 because their last projection was 4.2.
Right. That's what I'm saying. The
I'm really
dots are so
curious.
important. Yeah.
Like, I feel like if they don't bump that up, it's just
It's
disingenuous.
super dovish. I think if they don't bump that up, like they're like, yeah, it's disingenuous. I think I think they're going to have to bump that up, right? But like, I also think like you're going to see a dovish dot print. I just don't an entire dovish dot plot. I can't see how you don't get that, right? Like I think the move, if they don't want it, like the move is again to cut 50 basis points, but we'll see what happens, right? Again, the bond trade's not going to be made or broken with a 25 or 50 basis point cut. It's really the dots and like the guidance, and then ultimately like where the economic data comes in from here. So, um, back to where this whole bond thing is, like if you're looking at this chart right now and you're like, man, I listened to exactly what you just said, and I just don't really know what to do with this. Like, what am I supposed to do with this chart? And it's real simple. Bond TLT right now is at $100. Okay. The floor in the Fed funds cutting cycle is about 2.75. If you think that is too low, meaning you are thinking inflation is going to reaccelerate, you may be right, right? But this is not a rhetorical or like in any way facetious. The Fed funds rate is priced for 2.75 in the next 3 years. If you, at a minimum, that's the low before it lifts back out into the next hiking cycle. If you believe inflation is going to reaccelerate, you believe the economy is just in a little soft patch, so going to roar from here, rip and roar, and you believe that the Fed cutting rates at all is a policy mistake, therefore reigniting inflation, possibly overheating growth, you would say that the 2.75 rate, this blue line, is the floor. Therefore, bonds have little to no upside, right? Because if this floor doesn't drop, bond prices won't go up. So in that case, you don't want to be buying bonds, right? So that's how you look at this. Now, if you think 2.75 is too rich and there's a probability for a recession, if it does materialize, this will get dramatically repriced lower. I'm not saying to zero, but we could get this price to, who knows, below 2.5, right? Maybe even 2. Who knows? We'll see. These aren't price targets, they're just an observation. In that case, bonds are still cheap in terms of forward opportunity. There's still upside to be had. There's alpha to be had there. So that's the decision you have to make. And our system is saying the odds of the floor going lower are much higher than the odds of the floor reversing. And those odds are more definitive than the outlook for equities, which is why we're holding bonds and not equities at the moment. And I think that's why some people may not understand our process. They're wondering, why don't you have stop losses? Why don't you, what's your thesis? What's your price target? There are no price targets. There just aren't. And we're just riding the wave until the system says that the tides are shifting. We move out. Typically that happens like we did with the bond trade just a few months ago. It happens before the real moves happen. So we kind of get to front run it a little bit, and we reposition and we just ride the wave again. And that's pretty much our entire investment thesis and cycle process. We just keep going from one wave to the next and compounding along the way. But I think we can wrap the pod up there. It was a good conversation. So if you guys have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com, where you can get instant access to our models, our trading view indicator, and our private member area Discord chat room.